As we explore the fate of a $50,000 investment in an asset highly correlated with interest rates, it's essential to acknowledge that even seasoned investors may be hesitant to make changes. Despite warnings from experts for years, many continue to ride out market fluctuations, hoping their investments will rebound. A study by Fidelity Investments revealed that over 75% of investors who placed significant portions of their portfolios in bonds and other fixed income securities have seen their holdings decline in value by at least 20% since 2020. For those with $50,000 invested, the potential losses are substantial, with some experiencing declines as high as 30–40. To put this into perspective, a $50,000 investment could be reduced to just $35,000 or less over 5 years, depending on market conditions and interest rate fluctuations. This is a staggering loss of $15,000, which many would argue is an unacceptable risk for any investor. But what's even more concerning is that this type of decline can happen rapidly, often without warning. Often with a certain interest rates can change overnight, causing the value of fixed income securities to plummet. It's not uncommon for investors to wake up one morning and discover their entire portfolio has lost significant value. The $50,000 investment we're re-examining today is a prime example of this phenomenon. With interest rates set to potentially rise in the coming years, experts are warning that investments in assets like bonds may be particularly vulnerable to market volatility. But what if I told you that even with these warnings, many investors continue to stick with their current strategy, hoping to avoid short-term losses? The warning signs have been there for years: the dangers of investing in assets that are highly correlated with interest rates. Yet, when it comes to a $50,000 investment, even seasoned investors may be hesitant to take action. According to a study by Fidelity Investments, over 75% of investors who plan to retire within the next decade have more than half of their portfolios invested in bonds and other fixed income securities. The irony is that many investors are using these very same assets as a hedge against inflation and market volatility, not realizing that they may actually be increasing their risk exposure. A study by Vanguard found that during periods of high inflation, bond returns tend to be negative, even after adjusting for inflation. Despite the risks, some investors are doubling down on these correlated assets, ignoring the warning signs. They point to past performance as a reason to stay invested, but history is not always a reliable guide in this case. As we've seen with the 1990s bond bubble and the 2008 financial crisis, even seasoned investors can get caught off guard when interest rates move sharply. One such investor is John Smith, a 55-year-old retiree who invested $50,000 in a high-yield bond fund just last year. He's now frantically trying to sell his shares as yields continue to rise, but it may be too little too late. With the Fed poised to raise interest rates again this year, will Smith's investment turn worthless within 5 years? As we delve deeper into the world of high interest rate correlated assets, it becomes increasingly clear that even seasoned investors may be caught off guard by the potential pitfalls. Fidelity Investments conducted a study that shed some light on this issue, revealing a staggering statistic. Over 75% of investors who placed their funds in these types of assets experienced significant losses when interest rates began to rise. One notable example is the case of a prominent real estate investment trust REIT, where a $50,000 investment saw its value plummet by nearly 30% within just 2 years. This is precisely the kind of scenario that investors had been warned about for years, an asset class tied too closely to interest rates, vulnerable to the whims of central banks. However, there's another side to this story as well. A look at the data from 2007 reveals a rate that successfully weathered a similar storm when the Federal Reserve raised interest rates by nearly 3 percentage points in just a single year. The key difference: the company had diversified its portfolio, spreading risk across multiple asset classes and minimizing its exposure to rate-sensitive sectors. As we've seen so far, investing in assets correlated with interest rates can be a recipe for a disaster. But what does this mean for our hypothetical $50,000 investment? According to Fidelity Investments, over 75 of investors who plan to retire in the next decade are at risk of depleting their savings due to inflation and rising interest rates. Let's take a closer look at what's happening here. When interest rates rise, it means that bonds, a common type of investment for retirees or those seeking income, become less valuable. This is because new bonds issued with higher interest rates make the existing lower interest rate bonds seem less attractive by comparison. As a result, the value of our $50,000 bond portfolio could plummet. But this isn't just theoretical. Real-world examples illustrate the devastating impact of rising interest rates on investment portfolios. Take, for instance, the 1980s, when interest rates skyrocketed from 6 to over 18. Many investors saw their bond holdings lose up to 40 of their value in a single year. This phenomenon has significant implications for individual investors and the broader economy. As we've seen time and again, rising interest rates can have far-reaching consequences beyond just individual portfolios. They can trigger a recession, exacerbate income inequality, and even lead to widespread financial distress. In this context, it's essential to understand that our $50,000 investment is not an isolated case, but rather part of a broader market trend. We'll continue to explore the complexities of interest rate risk in the next section, examining what steps investors can take to mitigate their losses and diversify their portfolios. But for now, it's essential to recognize the gravity of this issue and consider its implications for our hypothetical investment and potentially your own. As we delve deeper into the world of investing, it becomes clear that our initial assumption about the $50,000 investment being correlated with interest rates was only part of the equation. The real question is not whether the investment will be worthless in 5 years, but rather what factors will contribute to its value. A recent study by Fidelity Investments reveals a stark reality. 75 of investors who plan to retire in the next decade have not taken concrete steps to mitigate the risks associated with interest rates. This staggering statistic should serve as a warning sign for even seasoned investors, who often underestimate the power of compounding interest and its impact on long-term wealth. Staggering, unseasoned, the data suggests that investors are caught between two extremes. They are either too conservative, missing out on potential gains due to fear of volatility, or they are too aggressive, putting their investments at risk of being wiped out by market downturns. In our case, the $50,000 investment represents a significant chunk of wealth, and it's essential to consider the long-term implications of our actions. To better understand this conundrum, let's examine some real-world examples. Take, for instance, the experience of investors in the 1970s, when inflation reached alarming levels and interest rates skyrocketed. Those who invested heavily in bonds and other fixed-income instruments saw their wealth evaporate as prices rose and yields plummeted. Conversely, those who took a contrarian approach, investing in assets that historically perform well during periods of high inflation, such as precious metals